Amazon and Alphabet are two of the largest tech stocks in the United States, and so understandably, investors are curious which one of these two makes a better buy for 2026 and beyond. I'll answer that question in this video, comparing these two companies across several important financial metrics, and I'll reveal my fair value calculations using my proprietary DCF model on these two companies. Of course, I own both of them, so I'm really interested in these two companies, and you'll see my answer, which might surprise you, on which one I think is the better buy for 2026.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
The first metric I wanted to compare these two on is revenue, and they've both done an excellent job in this matter. Amazon has increased its revenue from $136 billion up to $691 billion over the most recent trailing 12-month period. That's good for a compounded annual growth rate of over 20% during that time. Meanwhile, Alphabet has grown its revenue from $90 billion to $385 billion, good for a compounded annual growth rate of 18%. I don't know which is more impressive. Amazon has demonstrated better revenue growth, but Alphabet has demonstrated this revenue growth by offering primarily free products and services. That's what makes Alphabet's performance a lot more impressive to me, is because it's done this based primarily on free products and services supported by advertising revenue. Speaking of advertising revenue, Amazon is actually increasing its advertising business at a faster rate than Alphabet, beating Alphabet at its own game. But wait, on the flip side, Alphabet is demonstrating better cloud services growth compared to Amazon, beating Amazon at its own game. So you've got an interesting situation here where Amazon is growing its advertising business, which is something that Alphabet excels at, much faster than Alphabet, and then Alphabet is growing its cloud services segment faster than Amazon, which is something Amazon excels at, and Amazon is the leader in the cloud servicing segment. Either way, I think each of these two companies will demonstrate excellent revenue growth over the next decade, as they both demonstrated and invested significantly in expanding their core competencies and expanding their artificial intelligence capabilities. They've both invested hundreds of billions of dollars in artificial intelligence, in large language models, in developing supporting services, in developing their own proprietary chips to offer their customers in enterprise purchases of cloud computing services. So they've got excellent prospects looking ahead, and you can understand why I own both of these stocks. The next metric I wanted to compare these two on is the return on invested capital, which is becoming increasingly important as these large tech companies are spending so much money on AI. You want to see a management team that's capable of allocating capital effectively if you're going to see this capital allocation increase to the hundreds of billions of dollars over the next several years. And the good news for investors is they've both been excellent in this matter. Alphabet has demonstrated a return on invested capital around 30% most recently, and over the previous decade, this metric has been volatile for Alphabet, but averaged above 30%, which is excellent when compared with the weighted average cost of capital, which I'll share with you a little bit later in the video. Amazon has a lower number on the return on invested capital, but a better trend, which has improved from 7.1% in 2016 to 12.5% in the most recent period. Now, the good news for investors is Amazon over the previous decade, most of its capital expenditure had gone to the fulfillment and logistic networks for e-commerce, which is a less profitable business. In the most recent 2 years and looking forward, most of Amazon's investments will go to the data centers optimized for AI to support the AWS segment, which is a more lucrative segment, a more profitable segment for Amazon. It generates operating profit margins at least 3 times higher than the e-commerce segment generates. So you should see a continuous improvement in Amazon's return on invested capital both as a result of improving economies and scale on the logistics and fulfillment and warehousing side of the business, but also because of a greater percentage of its revenue coming from AWS, which is a more lucrative business. The next metric to compare is on the cash flow from operations to sales, and we see similar trends with Alphabet demonstrating a better number at 39%, but Amazon demonstrating the better trend at 19% in the most recent period compared to 13% in 2016. I expect Alphabet's cash flow from operations to sales will hover around these levels. I don't see very much improvement opportunity for Alphabet, maybe as high as 45% from the 39% level, but not very much improvement room. That's already going to be among the highest levels of any company in the world if they achieve 45% OCF to sales. Meanwhile, Amazon has a lot of room for improvement from 19% more recently. I wouldn't be surprised if they approach the 30% level before we reach 2030 if the continued investments in AWS returns the type of returns that the management team is forecasting and expecting. So now let's get to valuation. So on a forward price to earnings basis, they're almost equal, with Amazon trading at a forward PE of 31.5 and Alphabet trading at a forward PE of 30. This has been converging in recent weeks and recent months as Alphabet's share price has improved meaningfully while Amazon's share price has stagnated. So when I look at valuation using my proprietary discounted cash flow model, Amazon stock looks undervalued, trading at $235 when I calculated an intrinsic value of $273. Meanwhile, Alphabet stock trading at $315 compared to the intrinsic value I calculated at $290, Alphabet stock looks fairly valued when applying the margin of safety. So even though Alphabet stock looks fairly valued, I still think it's an excellent buying opportunity because it's a Hall of Fame business. Anytime investors can buy a Hall of Fame business at a fair value, I think it's a great deal, which is the situation I see with Alphabet stock. But Amazon stock is undervalued and it's also a Hall of Fame business. So I see Amazon stock as an even better opportunity compared to Alphabet stock. So I guess you could kind of see where I'm going with the answer to the question I posed in the headline of which one of these two is the better stock to buy for 2026 and beyond. If I had to pick only one, I would pick Amazon. But as I mentioned earlier, I like both of them. I have them both rated as a buy, and I own both of them in my personal portfolio. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in-depth members-only content.